Hey, Zuber, I heard that you brought up the fact that buyers and investors out in the market trying to purchase are gaining power. And
Mm.
that's absolutely what we're seeing in the data. If you take a step back and you look at the numbers, and yeah, it varies by market, but the general gist that we've been seeing since the pandemic housing boom fizzled out and mortgage rates went from 3, 4, 5, 6 to even 7% and briefly to 8% is that we've seen a market that's trying to normalize, trying to recalibrate after going through that pandemic housing boom, that period where housing demand just ripped, right? The Federal Reserve estimates that in order for the supply of the market, new construction to match the increase in demand, housing starts would have needed to increase 300% during the pandemic. That's not possible, right? You can't go from 1.4 million housing starts to 2.8, that's 100%, then to 4 million, which is 200%, and then even up, just under 6 million, right, to kind of get to that 300% increase. You can't do that. So what happens is that the market, when there's that much more demand than supply, it overheats. And that's what the market did. And so prices shot up, right? And so where we've gotten to is just this strained period where, because we saw so much run up so quickly and affordability deteriorated so fast, the market is still trying to recalibrate to that. Now, the market moves slow, right? And the other thing is that prices as well historically are sticky, right? And so as this market slowly shifts and buyers or sellers cannot necessarily get the number that's in their head, and that number in their head might be higher than even comps because they're just used to this decade, right, where they just come out and price it above comps. And so as that shifts, right, and as active inventory builds and sellers can't sell as quickly, slowly over time, buyers begin to gain power, right?
Correct.
And buyers might not gain as much power for the homes they might necessarily want the most, like the most desirable homes in the most desirable school districts and communities. But there are properties out there when you see a market shift that buyers and investors in particular are definitely gaining power, right?
Yeah.
And as that active inventory builds and gets higher, and sellers begin to realize, oh, I can't necessarily get the price that I had in my head. I might need to be more flexible with the buyer. I might need to throw in incentives, right?
Yeah.
I might need to even pay their commission. I might need to come down on price. And so those things, are as you get the active inventory in the market building more, right? And you start to see the share of homes in your market getting a price cut. That's really good data, and compare that to the same month, from year priors. And so let me share my screen and kind of show you what I'm seeing in the data.
Love to.
So let's jump into it. Can you see my screen?
I can. Yes, I can.
Okay. So you see here that even in great markets, it's worth pointing out that you will always see some homes on the market with a price cut.
Sure.
Even in a market like a March 2021, when prices are ripping, there's always those people who come in just too high, right? They hear about it ripping and they just come in too high. And also it's a part of some agents, tactics, right? Where they like to come in a little, some like to come in lower, some like to come in higher. It just kind of varies, right? And so you historically always have a share of price cuts. But what you've seen is, since the pandemic housing boom fizzled out, is you've been seeing this number go up, right? At spring 2023, although, that was a decent spring selling season, it was still a much higher jump than it was the previous years. When March 2021, March 22, those are probably the hottest springs almost ever. Even a lot hotter, even in some places hotter than they were in 03, 04, 05. It was just a really condensed boom in a small window. And as you see this number continue to move up, you're seeing buyers and investors out in the market gain power. And so this chart here is that same price cuts figure, but it's also, it's as a count, and it also has active inventory for sale. And so what's kind of crazy to think about is that right now in the market, there are almost as many homes for sale that have a price cut is there was all homes for sale altogether in
I
March
saw that.
too. And
That's
so
wild.
and so you can see this market here, really, you can see the trend, right? Where we have, we had like a decade period where actives are slowly going down, and that's kind of the recovery decade for housing. And then we have this period we go into the pandemic, right? And housing demand rips, all the things that go into the pandemic economics, right? And it's not just the pandemic itself, but it's the fact that, you had so many people working from home, so it increased the demand for space. You had work from home arbitrage where people could go from higher income markets like New York, San Francisco, and seek affordability other places deep into the exurbs or third, secondary markets. And then the fact that there's just so much stimulus in the economy and the ultra low rates that made so many things cash flow, right? So housing demand just overwhelms the market. Actives soar down, prices overheat, and then since then in this new market, right, where we're recalibrating, trying to normalize into the strained affordability environment, you see actives moving up consistently. You see the price cuts moving up consistently on a nationally aggregated basis. Now, here's year-over-year change in home prices. This is 5 major indices: Freddie Mac, Zillow, Case-Shiller, FHFA, Cotality, which was CoreLogic before they rebranded 2 months ago. You can see that year-over-year prices are still positive, but they're decelerating. And the Zillow Home Value Index, although it includes condos, which is kind of a little bit of the reason it's below the others right now, it's also a little ahead of the others. So I expect these most likely to decelerate, nationally aggregated. And so if you go around the country, you will see that there are some pockets that have softened, and investors and buyers out in the market have gained more power than other places. So one key data point that is very correlated with decelerated prices, softening prices, and even potentially prices falling some is the active inventory in your market compared to pre-pandemic 2019.
Yes.
And so that number, where we are, like, let's say we get to 2019 inventory nationally, which is going to happen in 4, 5, 6 months this year. That doesn't necessarily mean that if we stay there in 4 or 5 years, that it's a market that is going to be very weak necessarily for pricing. But the movement up to that and kind of coming out of that overheating and seeing actives rip back up, that's to get actives moving up that much and that quickly. It means that the supply demand equilibrium in that market has shifted, right? Demand has shifted and cooled. And that's why the active inventory is building, right? Because buyers aren't buying homes as fast as they were before. Homes are kind of sitting on the market longer, and it kind of builds. Now, you are also starting to see finally some easing of the lock-in effect, and some people have been holding out to sell. It finally came in, and that's a part of it as well. But what you see is that back in January, 41 of the nation's 200 largest metro area housing markets were above 2019 inventory levels. And as of April, it's 69. So it's continuing to rise. And I expect it's going to rip over 100 in a couple months or less. In the real world, it's pretty close to that already.
Yeah, the trend is clear. Yep.
Yes. Now, where buyers and investors have gained the most power is in a lot of these Gulf markets in the Sun Belt and a lot of the Mountain West markets. And so you can see here, if you go through it, Texas, a Florida market, a Colorado, Florida, an Alabama, Texas, Florida, Colorado, Texas, Washington, Tennessee, Texas, Tennessee, Florida, Texas, Florida, Washington, Texas. A lot of Texas, a lot of Florida, a lot of Colorado as you go through it. And some of these markets, like a Punta Gorda, is 100% above 2019 levels.
Wow.
So they went from, in April 2019, they had 2,400 listings. At the peak of the pandemic housing boom, they had 500, 600 listings. And now they have almost 5,000. So Punta Gorda is a metro of 200,000 people. And it now has more active listings for sale than the entire state of Connecticut.
Oh my goodness.
Which is
Wow.
the tightest state. Connecticut and New Jersey, everything that I've told you so far, barely any of that applies to Connecticut and New Jersey and some of these Northeast markets. That while they are seeing actives begin to rise, and maybe I have that table here. Yes, I do. You can see Bridgeport, Hartford Metro, right?
Yeah.
Illinois, they're still down 70% from pre-pandemic levels.
Crazy.
And so Erie, Pennsylvania, which is just above Pittsburgh, they have 168 active listings. And they had 1,000 right before pre-pandemic is kind of where they were saying. So there are still tight markets, but the aggregated trend is that we're seeing a market where buyers and investors out on the market trying to buy are gaining power. And, you know, one of the interesting groups that's kind of hard to figure out is home flippers, right? Because it's like, you know, and I spend a good amount of time trying to think about this, and I would love to hear from some home flippers as well on kind of how they interpret it. But it's kind of a catch-22, where in these tight markets, right, the Northeast, some of these Midwest markets still, especially Connecticut, home flippers, while they're holding the homes, right, they're still seeing appreciation, right? And seeing, you know, in some places, even like Hartford, elevated appreciation, right? But when they're out trying to buy properties, it's 80% below pre-pandemic active inventory level. And there's so many first-time home buyers out on the market that it's kind of hard to find properties, right?
Yeah.
But
well, I can tell you what the home flippers are doing in those markets. I talk to 3 or 4 of them every week. Most of them are not dealing with on the MLS, so they're not going to the 168 homes in Erie, Pennsylvania. They're doing mailers, cold call, texting. They're getting they're spending thousands, if not tens of thousands of dollars to find off-market opportunities. That's what they're doing.
Yeah, so very much so like the pandemic housing boom, that where, you know, when everybody was getting mailers in the mail.
Correct. That's how they have to do it. They can't compete in a market where there's only 168 on market and all the eyeballs are on it. They have to generate off-market opportunities.
Now, on the other side of that is in the Sun Belt, especially Florida, Texas, Colorado, it's easier to find those properties for sale, right? And you can probably work down in some places the seller potentially too.
Oh, no question. This chart is very telling to me because investors, the people that I speak to every week, the Gulf, right? Those green or whatever color that is, area bubbles. That's where you can shop on market.
Yeah,
I would shop in the MLS because what you can do is you can just search on days on market. You can look for price cuts. You can do some extra research like loan balance, loan origination date, stuff like that. But I would be extremely aggressive, aka disrespectful with offers in the Gulf, where my strategy up around Hartford would absolutely not work. Not enough inventory, too many eyeballs, you know. So again, my strategy of disrespectful offers works in the Gulf, does not work in the Northeast.
and so then when it comes to prices, the number of the 300 largest markets that have seen price declines has gone from 31 down year over year in January to now 60. So it's doubled. And what I expect is I expect this to go over 100 very soon, based on what I'm seeing in the pulse of spring appreciation. And we've talked about this a lot, right? Where, you know, markets, even some of the markets that are going to finish down on the year can still potentially see their number for, you know, prices jump up a little bit in the spring, right? But the telltale of a down year is your spring appreciation is very weak, right?
Yep,
Where
correct.
it's like very faint, or even flat. If you're flat, that's even worse. And so then usually when you go into the second half of the year, that's when you see more of the price give up. And right now on a seasonally adjusted basis in the Zillow Home Value Index for March, half of the country was seasonally adjusted down month over month for home prices in the spring. And so, you know, if that holds, then, you know, once we kind of get into the back half of the year, that seasonally softer period, that data point is telling us that that's when the give up would most likely happen.
Yeah.
Now, one that's interesting is when you look at the appreciation, 2008 is a crazy year because that's actually a year on a nationally aggregated basis. You actually saw home prices, not just seasonally adjusted, but beyond seasonally adjusted, actually fall a little bit in the spring. And that's that. And
That's
by
abnormal. Yeah.
that, and by the way, our data that we're seeing for this spring is not like that. But that was the year that, prices really in that second half of the year really fell off a cliff. And you saw some of the markets give huge give ups. But here's the year over year. You can see it's that Southwest Florida pocket that's been the weakest. Still Texas has still been weaker. And you have to be a little careful with some of the numbers you hear some of the agents throw around, especially if I was a buyer investor. Some of these agents will throw out average prices and medians. And if you dig into it a little more, and I'm not saying you shouldn't use averages, you shouldn't use medians, but sometimes they do get caught by mix shift.
Sure.
And
correct.
And I've seen some of the numbers from Austin have definitely gotten some of the mix shift, especially on the average prices, which if you're going to use an aggregate of the sales price or list price that doesn't account for a mix shift, at least use median, because the averages really do swing a lot.
Agreed.
So what I mean by mix shift is the overall sample that goes into, creating that median or average. And it can go both ways sometimes, where sometimes a median or average over time could show in a smaller window a decline, and really it was an increase. And sometimes it could show an increase, and really it was a decline.
It's funny you bring that up, because one of the things I've said kind of counterintuitive is if we waved a magic wand and 30-year mortgage rates were 4% again, we would actually see, or I'm proposing that we could probably see median home price fall, because you would unlock so much of the lower end.
Yeah, well, so that's an interesting point, is like, where is the lock-in most acute? And you're probably right. It's probably in that bottom half of the market, because those are the people that, bought, and then, you would potentially move up, right? And the move up is really what doesn't make a lot of sense.
Correct.
Where, you could be going from a $2,000 payment to, I don't know, a 6, 7. I mean,
most of them would get a no answer. That's the problem. They get a no answer on the move up. So it's not even an option. They got to stay put.
Yeah. And so, and let me show one more chart actually before we jump. And anybody could sign up for Resi Club's newsletter. I have a free one. You go to my site, Resi Club Analytics, put in your email there, sign up. And then I also have some premium reports that go to my pro members. I do 3 per week. And so what you see is, here's what I showed you earlier. And I think that this chart is really one of the best ways for getting a quick indication of the supply-demand equilibrium. These dark brown markets, those are tighter markets, right? The ones that are far below pre-pandemic listings. These green places, buyers, investors out in the market trying to buy, have gained a lot of power.
Seller and buyer's market, very simple.
What you will see here is that the year-over-year change for actives is increasing just about everywhere. So while there's still tight markets, you are seeing growth in much of the country. And one that's in particular, this a part of the West has started to see actives really over the past year really start to jump back up, right? And so
absolutely,
western part of the country in the second half of 2022, other than Austin, but the West was the weakest part of the country, right? And, a lot of my theory there is that the West is just more rate sensitive. It's rate sensitive because its economy is more tech-based, and those industries got, there were, you saw a lot more like software engineer layoffs, right? When rates got up, right? Very high income software engineers. And then the other factor is that the West on a, when you look at the fundamentals, because there's been such a tight market, such a buyer's market or seller's market for so long out West, that you've seen the ratios in terms of like price to income, right, get really out of whack, right? And so people out west have been stretching themselves thinner than other parts of the country for a long time, right? It's not just been the past few years. And so I think when you see rate jumps, because people are already kind of at that bandwidth, it just causes a bigger jolt to that market. And if you actually peel back the onion, if you go back and look at 2018, while rates didn't move up as much then, in San Jose actually fell a little bit in some of these indices, and San Francisco weakened a bit, right? And then those markets, once they kind of absorbed that rate shock, it was right back to where they were before.
Yeah.
But you are starting to see the western part of the country start to see actives build. And then also the Carolinas, Georgia, you are seeing softening definitely in Atlanta. And then looks like that's the DC area is starting to move up there. And which bubble is that? Yeah. Let me actually check that. Looks.
Sure.
Let me check on DC again. Oh, I missed that. Look, see the jump?
Yep.
Wow. Give me a second. I want to do a little investigation live on this.
Ah, look at you.
Let's take a look at the metro for. Oh boy, I wasn't paying enough attention.
Look at that.
Yeah, that's for the aggregated metro. I got to tweet that out.
Yeah, clearly something's going. So again, what there's so much you've gone through in this 20 minutes that I think people need to pay attention to. One is active inventory is clearly grown in much of the country. That is, in my opinion, that is a sign that demand has cratered in lots of areas. Not necessarily there's been a rush of more supply, but we have demand. The other thing we have to realize is all inventory is not created equal. I think there's two things that are true as I validate them across the country. We are still seeing a relatively competitive market below the median. It's above the median that is starting to stack up and become a problem. For example, in Orange County, we're seeing 2x the median now have 300 days on market, where below the median is like 45 or something. The other thing that I think a lot of people need to realize, and you brought this up at the very beginning, is sellers. There's a lot of sellers, and it's hard to put your finger on these, but how many sellers have what's called wish pricing? Like comps say it's worth 350, but the seller puts it on at 400, right? That still counts as an active inventory, but is it really active if the seller's not going to take anything less than 400? Right. So we do have a lot of folks up there. So that's why, in my opinion, you brought up also in the beginning, price cuts. Price cuts are a sign that seller is at least motivated at finding a price point that works. If you have a property on the market for 90 days, never had a price cut, doesn't counter any offers, below 400, that's just wish pricing and, not really an active listing. So lots of stuff going on in this market as it clearly moves from a seller's market to a buyer's market in more and more of the country.
Housing. Thank you for having me on, Zuber. Anytime. And I'm going to keep tracking this very closely. And if people want to find my stuff, at News Lambert on Twitter, Lance Lambert on LinkedIn, or ResiClubAnalytics.com.
Folks, if you're following me and you're not going to Resi Club Analytics right now and getting the 5 free articles, you're just missing out. Also, he's a must follow on Twitter. He's putting out multiple tweets a day that are just very, very relevant and very, very important. Thank you for everything.